Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Bob Yager. He's a senior energy analyst over at Mizuho Americas. And just like every other market, the oil market is waiting for the Fed as well. Bob, it's great to have you with me as always. And I feel like I just can't wait to get Wednesday over with so we can see how these markets respond to what the Fed's going to do.
Yes, you can see from this chart that we are stuck in a bit of a range here that is waiting for the Fed to make their decision. The previous week, we were coming apart rather quickly. And it's really amazing that that did happen. It's in the face of geopolitical tensions in the Middle East also. And market kind of brushed that off. And we are a very well supplied situation. A lot of crude oil in the global system. You had OPEC, the IEA and the EIA, the news agencies, all coming out and saying that there's a lot of crude oil, that there's concern in the second half of the year into Q1. And the market was able to trade lower in the face of geopolitical concerns, despite that, despite the tension that it usually builds in the market.
Yeah, it's really interesting because everything's so focused on the Fed. We're seeing in the equity market as well, as you know, where no other news matters, despite the fact what we're seeing happen with geopolitical tensions. Now, what about global growth impact on oil? Because we're not seeing much of that growth anymore.
No, we're not. And that's a big issue also. This is just not a supply side conversation. This is also a demand side. And the IMF came out last week and they gave a hit to global demand, global strength. And the market came off really quickly on that. It was a nice hit. The market is looking for some kind of demand indicator. So when it came light last week that the trade team was heading for Shanghai, that was viewed as a demand indicator, a positive demand indicator. Maybe we can get this trade situation done. Maybe that will add some kick to global demand. And we had our best day to the upside on a trade situation, not an Iranian situation or something that you would think, or a storage situation. Storage has been down for 6 weeks in a row, and we're still drifting lower. It was higher on perceptions about maybe an increase in demand from the trade talks.
Right, but even look at the summer driving demand season in the U.S., it's been anemic.
It has been. The EIA weeklies, year-on-year, 4-week average has been lacking for sure. And the market has, it's just not there. The gasoline crack today was trading about $19.50, in my opinion. Dead of summer, peak driving season, it's got to be well above $20 to really show a strong demand for that side of for driving demand. And it's just not there.
Right.
And it's not materializing. And there's only a couple days really until the end of summer. Summer for driving season, as far as we keep track, it ends a little bit earlier. So we have to end quickly here on the strong side of the ledger.
But why is that? Do people just not drive anymore?
People are not driving as much. Yeah. You got fuel efficiencies also, and it's definitely taking a hit. There's no way you can argue that the driving season has been a success. So yeah, it's less than it has been. People are driving less, and it's not good. Not good for crude.
I wonder if that is part of the Uber economy, because I could tell you anecdotally, kids just don't want to get their driver's licenses anymore. I remember when I was younger, you would count down the days. Now they just don't want to drive. Nobody wants to drive. I don't want to drive. So you wonder if that's part of the impact. I don't know.
I think you're hitting on something, because I agree with you a million% there. Of course, we're not driving a 1976 Chrysler. Right. I'm 55, but I would have guzzled up the 5 kids these days. But yes, it's just not that kind. I will say I drive home on the Parkway on every day, and on Friday it's still bumper to bumper. So there are people still going to the shore, but yeah, it's just people don't drive as much as they used to. You have the computer and everything else at your disposal. You can have stuff delivered to you quickly. You don't have to go fetch it yourself as much.
Well, and that's a great point as well. Let's wrap it up with this. Energy equity performance. Are you seeing it translate to the stocks?
You always do to a certain degree. I would make the argument that we stopped at $55 support. One of the reasons was you have a relatively strong stock market. There's a loose correlation between energy and the stock market. It is a demand indicator, so it serves as such. Last week, though, S&P was in the green. All 3 parts of the energy slate were all in the green, but S&P 500 energy was in the red for the week. That correlation is usually pretty tight. It's a bit odd, but the utilities and energy were the only 2 sectors in S&P that were in the red last week, though gasoline, heating oil, and crude oil were all in positive for the week.
Interesting. Thank you so much, as always, for joining us at MarketSite. And thanks for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.